Good afternoon and welcome this afternoon to another great webcast from Schwab Coaching, getting started with technical analysis. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20 plus year veteran of the financial markets. He's there to help facilitate the conversation and keep that flowing. If you're here in the recorded version, we're glad to have you with us as well. Be a part of the conversation by leaving us a comment in the comment section as we get into this discussion today. I'm filling in for Barb Armstrong in this webcast, and I get the opportunity to start this cycle of content over again. So this particular webcast is part of a playlist. It is a 9 week rotation of webcasts. Occasionally, we will throw in a few one-off discussions, but we're going to go back to the beginning, and I'll curb my urge to launch into my best Donny Osmond, Joseph and the Amazing Technicolor Dreamcoat imitation, and say, may I return to the beginning? And we'll start with lesson number 1, an introduction to technical analysis. And we'll get into that discussion here. As soon as we cover a couple of quick housekeeping items, remember that everything we talk about, simply for illustrative and educational purposes only, it is not a recommendation or solicitation of any particular account type or strategy or anything else. If we happen to discuss any options content, which I don't believe we will in this discussion, options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option transaction. Now, the obvious focus of this particular webcast is technical analysis, thus the name. However, there are other approaches to analyzing the market, including fundamental analysis, probability analysis, other types of analysis. Those are also theoretical in nature. None of those are guarantees as to what the market is going to do. And because of that, Schwab doesn't recommend the use of any one particular method. It's solely as a means of investment research. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version of that platform, to use our examples and discuss things today. It's a great learning environment, great practice environment. However, it is not a guarantee of future success out there in the real world. And as you move your practice from paper trading to live trading, you'll recognize that there are some things that the paper money account does not do that a live trading account may do. So we're jump into this discussion here again. This is kind of the general tenet of fundamental and probability and technical analysis, is that past performance is no guarantee of future results. But as we get into this discussion, one of the things that we find out is that many traders still feel that technical analysis ought to be able to tell the future, and it just can't. You try to do these things, Nemo, and you just can't. Technical analysis is never going to tell the future. It's going to give us a tool around which we can make decisions. Now, how we make those decisions gets broken down into a variety of tools. First of those is the lesson that we're going to talk about today, the understanding of the basics of technical analysis. And we'll get into some of the basics of charting and some of the basic concepts of trend and so forth today. But lesson 2 focuses specifically on trend moving averages, and then support and resistance, and then candlesticks, and then a couple of 3 or 4 different types of price patterns, and then technical indicators, and then divergences from those technical indicators. So that kind of brings us full circle in that discussion of technical analysis. So we're going to talk about this today. What and why when it comes to technical analysis, the principles, the charting basics, and some of the key points of charts. So let's take this idea and kind of break it down a little bit. Technical analysis has kind of 2 different analytical approaches to it. Technical analysis is the study of historical price and volume to identify and project price trend. Now, when it says project, that's where we have to kind of be careful a little bit, because we make projections about what might happen, and that gets awfully close to that dangerous area of trying to predict the future. And the problem with predicting the future is it very, very rarely turns out the way that we predict that it is going to move or going to happen. And because of that, what tends to occur is those that are skeptical about technical analysis say, see, I told you so. Told you technical analysis doesn't work. Well, if we frame technical analysis in what it can do, what its reality is, which is as a decision-making framework, then we have a much better chance of being able to gain some useful information from technical analysis. So there's a phrase, before we leave this and go to the fundamental analysis component of this discussion, there's a phrase that I want you to become familiar with, and that is, if this, then that. If this happens, then this is the decision that I'm going to make, or I've already made, and then this is the action that I'm going to take. So an example of that might be, if price breaks out above a resistance level, then enter the trade. Or maybe even simpler, if stock XYZ or ZYX is in an uptrend, then I'm going to enter the trade. Else, I'm going to wait until it is in an uptrend. And likewise, if we were getting out of a trade, if price breaks a level of support, then I'm going to exit. Or if there's evidence of a downtrend, then I'm going to exit. Else, I'm going to wait. Fundamental analysis is a little bit different. Fundamental analysis is as theoretical in nature as technical analysis because news changes everything. One. And two, fundamental analysis is based on publicly available information. And if it weren't, if we were talking about insider information, then there's probably something nefarious about that. But if fundamental analysis is based on publicly available information, then everybody has access to it, then fundamental analysis is just as theoretical as technical analysis, because not only is it subject to interpretation, number one, but it's subject to filtering and parsing of the information that's publicly available, i.e., the company lets us see what they want us to see. So analyzing a company's financial statements and balance sheets and income statements, looking for value or potential growth, sure, great way to find an individual stock that maybe a trader or an investor wants to have in a portfolio. Then we rotate back to technical analysis to be able to help us to make a decision about when we can get into a trade or when we can get out of a trade. So let's jump into the next part of this discussion. Some of the tenets, the basic tenets of technical analysis, is that price tends to move in trend or trending fashion. It is not a random discussion. Price tends to move bullishly, bearishly, and sideways, or in other words, up, down, and sideways. And an uptrend is clarification of and validation of demand. There's enough demand to push prices higher. A downtrend is validation of supply, that there's enough supply to push prices down. A sideways trend is validation of equilibrium between those two forces. Supply and demand pretty much drive price movement regardless of whether we're talking about fundamentals or technicals or probability or anything else. It is that supply and demand and those imbalances that occur in supply and demand that drive prices in trend. And so when we talk about a trend continuing until a trend ends, it is continuing until there is no more demand or no more supply, or an end of that demand and an end of that supply. So we get into this discussion of technical analysis, and we have to assume that the market knows everything. It discounts everything. Just like we have to make that assumption when we're doing fundamental analysis, that the available information that we have is true and correct. We make that assessment. That's kind of the basic fiat that we enter into this discussion. So the basic fiat that we enter into the discussion of technical analysis with is the market knows all the available information at the moment, and it's currently digesting that, and it's expressing that in the current price of a stock. Now, news, in both cases, news meaning emergent new information. That new information can change both the technical setup as well as the fundamental setup. And the inherent nature of news is that we can't predict it. If we could, it wouldn't be news. It would be information if we could predict what that information was, first of all. Second, the other thing about news is that we can't predict how the market is going to react to that news. So even if we knew what an earnings announcement result was going to be, we don't know how the market is going to react to it. but we assume that the market knows all of the available information at the moment. And there's this other element that human beings tend to drive the market. I mean, in fact, that is the only thing that drives the market is the opinions of human beings. History repeats itself, or it tends to look similar because humans tend to react similarly in similar situations. So there you go. Now, as we get into this discussion a little more, we'll see how that bears itself out. But some of the benefits of technical analysis are that looking at a chart with trends and support and resistance becomes relatively intuitive. They can see and visualize price movement, but some traders don't. Some it's difficult. So we're going to break some things down, give you some tools over the course of this discussion that may be helpful. Now, technical analysis is flexible. It's transitory across a lot of different time frames, a lot of different instruments. If you're talking about a futures contract or an options contract, or you're talking about a fixed income contract, or you're talking about an individual security or an ETF or something else, technical analysis works in all of those circumstances. And it's portable across different time frames. So we take a look at an intraday chart versus a weekly chart versus a monthly chart. You're going to see trends and levels of support and resistance existent in those different time frames, just the same way that you would in a longer term chart. So as we start to kind of bring this into the discussion, some of the risks of technical analysis are that we tend to have, as human beings, behavioral and cognitive biases that we have to deal with. One is that we tend to look for confirming information. Those cognitive biases can help us to make poor decisions. So if we can get over those, technical analysis maybe can help us to frame those decisions outside of those cognitive biases that we have to deal with as pesky human beings. Now, if we were robots, it'd be a lot easier, right? Because we could just be programmed. But wait a second, it's human beings that are programming the robots. So they're imparting, whether you're building and training an AI model or whether you're writing a mathematical algorithm, it's human beings that are writing that. So we're imbuing those robots with our own cognitive biases. Now, there's also this idea of slippage, and slippage is the risk that a security's price will move more than you expect, or maybe even less than you expect. Trend application means trends are often easy to spot in hindsight. It's easy to kind of best fit some lines to prices. And that can definitely happen. And again, that's another cognitive bias. It's that kind of anchoring perspective. And there's another risk here. And that technical analysis is, by nature, somewhat subjective because it requires discretion to interpret. It requires discretion to draw lines. Now, we've got some other tools that we can use to help kind of take some of that subjectivity out, mathematically derived tools and so forth, that can help to minimize that subjectivity, make it a little bit more objective, and a little bit more of a discretionary, but discretionary with evidence-based decision-making process. So going back to that idea of if this, then that. If this happens, then I know what I'm going to do, else I'm going to wait. So then we become more algorithmic on our own right now. So discretionary systems versus non-discretionary systems. A discretionary system relies heavily on a technician's reading of a chart and price action. Hey, it looks like this, therefore, this is what I think it's going to do. And it requires human interpretation that, again, incorporates information and bias into the mix. And it also is difficult for others to replicate. But a non-discretionary system that is just signal-based, for instance, if price is above a particular level, that's an absolute. That's not discretionary. We can make an objective decision based on price being above or below a particular level. It's mathematical and methodical, and it removes some of that bias. So if we frame technical analysis not in a discretionary fashion, although we know that it is going to be by nature discretionary, we frame it in this non-discretionary approach to decision-making, if this, then that, then we take out of the mix some of those biases, not all of them. And one of the tests, perhaps, of a non-discretionary system is that specific, simple, repeatable rules can be written Those repeatable, simple, specific rules can be delivered to another trader, and that trader can replicate not necessarily the success, but replicate the entries and exits into and out of those trades. And so that is maybe one of the best hallmarks, perhaps, of a non-discretionary trading system using technical analysis. So we're going to start by this idea of building a repeatable format. Watch list criteria. What is the stock that I'm going to trade? What do I want to trade? All right. And that kind of goes back to these first two, watch list and what to trade. So determining a watch list of stocks that we're going to keep an eye on. Second, when do I get in? Third, how much do I trade? Meaning how big is the position that I take? Fourth is exit signals. When do I get out? And the fifth is, what do I do on an ongoing basis to make sure that that machine is being fed, if you will? So what do we trade? When do we trade it? How much do we trade? When do we get out? And what do we do on an ongoing basis? That's the basis of an investing plan, a trading plan, a technical analysis plan. Now, that's not specific nor specifically and solely exclusive nor just germane to technical analysis. You could use the same approach to a fundamentally derived or a probability-based plan. Your entry signals and exit signals could come from something that is fundamentally driven, more so than technically driven. But you may have less flexibility in how you do that. So let's jump out to the platform here really quick. We're going to go into the basics of a chart, and I'm going to kind of talk through this, but I'd rather do it on the platform, on the Thinkorswim desktop software platform, than here in this slide, because this is static. I want to see a little bit more dynamic environment. And speaking of dynamic, when you think about the market, the market itself, the stock market, the options market, the futures market, these are enormously complex, but also enormously dynamic and multivariate systems. So to try to isolate one particular metric, price to book ratio or probability of touching a level, out of all of those multivariate inputs becomes a little bit difficult. So technical analysis helps traders and investors to crystallize and visualize what's happening with price movement, assuming that the technical analysis system is projecting all of that available information and resolving it to one discrete, exquisite price, whatever the price of the stock is trading at the moment. And here we have on this chart, Google, Alphabet. The symbol is Google, Googl, not a recommendation, but simply an example of a stock that many traders know. And taking a look at where the price of the stock is currently, it's at 348.87 and change. It's down a little bit on the day. I can see that over here on the right-hand side. We've got an earnings announcement tomorrow after the market closes. So that's creating an influence, and that's presenting some uncertainty to the market because we don't know what the results are going to, the earnings announcement are going to be, number one. And number two, we don't know how the market's going to react to those results, and neither do you. So as we talk about this, I'm going to take a couple of steps back. This is a little bit more advanced. We're going to take a couple of steps back when it comes to this price movement that we're seeing on this particular chart. So just for those of you that are absolutely box stock out of the gate, newbies to technical analysis, we are looking at price over time. Price on the y-axis, time on the x-axis. And price over time gives us a typical price chart for a stock price over a period of time. This is a one-year daily chart. You can see that repeated a couple of different places. I've got a label on here. I've got a scripted label. I've got a label that comes automatically with the chart. I've got information over here at the top of the chart that shows me that this is a one-year daily chart. So each one of these periods that's showing here, each one of these little increments is showing me 1 day's worth of trading time. But I'm going to change the style of this chart for just a second. I'm going to change it from what we will come to learn as a candlestick chart back to kind of the basic view. And if we get to that basic view, we might, at its most basic level, look at a line chart. And this line chart is just simply taking closing prices, the price at which the stock is currently trading at when time runs out every trading day, and it projects it as a line. And so if that print is higher, the line goes up. If the print is lower, the line goes down. And so this is price over time. And we can see that Google's closing prices have been getting a little bit lower in this time frame over the last couple of months. But at the same time, they've been making slightly higher lows, meaning they've started to pick back up a little bit, maybe kind of narrowing the range of volatility or range of movement that the price of this stock has been moving in. So a line chart is just simply one way to project that time. So JJ asks a great question, and I think it's a valid question to ask at this point. How do you individually, as a trader, as an investor, choose the time frame when you are buying? And the answer to that question is, well, that's a good question, because it's going to depend on your level of risk tolerance, your intent in the trade, your willingness to be active or less so in terms of managing the trade. So I would argue this in general terms, that the less hands-on you want to be, the longer your time frame perspective might be. The more hands-on that you want to be, the shorter your time frame has to be. Or maybe it's a chicken and egg scenario. You want to be involved in the trade on a short-term basis, meaning intraday, maybe 1 minute or 5 minute or an hour time increments that you're using to make decisions. That's going to require more hands-on effort because things are just moving faster. And as Ferris Bueller says, sometimes things move pretty fast, and if you slow down, you're gonna miss them. So when we talk about being a longer-term investor, we might slow down our time frame. We might make this, JJ, a weekly chart over a longer period of time. I'm going to make that a 3-year weekly chart. And you can see that if I make it a 3-year weekly chart, gosh, that line looks a little bit different. I've got a couple of different labels on there because I use this as a means to do some other technical analysis. But you can see that this is a 3-year 1-week chart, which means that every closing price is an average 1-week closing price, and it's plotted in a line. But it's a longer term time frame. I could go out to a lot longer time. I could go out to, well, we're at 3 years now. Let's go out to 20 years on a weekly basis, and you can see the trend of the stock over that course of that longer term time frame. So if I were a longer term investor, I might be looking at something like this, a 20-year weekly chart, and saying, hey, look, as long as this trend continues to move in a particular direction, I'm okay getting into this trade regardless, because my intent is to stay and ride that longer term trade as long as that wave keeps going towards the beach. So that's one perspective as a longer term investor. If I'm a shorter term trader, I might pop this down to a 5-day, 5-minute chart. And now this chart is showing me movements with increments of time that are 5 minutes long. And I can see that that chart looks vastly different than the daily chart did, than the weekly chart, that longer term chart. But I've got to be quicker. All right. This is where not paying attention does not benefit you as a trader. And you can see that price is moving. In fact, if I were to bump this even down one more increment, we might take this down to a 1-minute chart. And as the price moves on a 1-minute basis, there's a lot more noise here. In fact, let's even do one more thing here, and I think this might be kind of cool. I'm going to change the time frame on this chart from time to trades. I'm going to change this to a tick chart, what's referred to as a tick chart. And a tick chart just aggregates trades, and then it moves the price and plots that line on the course of the number of trades that occur. Now, we're going to use a 1-day time interval, and I'm going to use an aggregation period of 42 trades. So when 42 trades go off, boom, we get another print on the chart. And I'm going to go ahead and I'm going to click on OK. Now watch what happens here. So I'm going to scroll over to this right-hand side, and you can see the counter right here. There we are at 4, 5, well, it's 7, 8. It's not trading very fast because we're kind of right in the middle of the day. But every time we get 42 ticks, then there's nothing magical about that number other than that's the answer to everything. But 42 ticks, we get a new print. And so when we get a new print, then that line is going to move. So we can see that line moving up and down. We can be as frenetic as we want to be with technical analysis. We can be as lackadaisical as we want to be with technical analysis. It depends on your time horizon and your expectations. So let me change this back to a one-year daily chart. So the line tool is useful, but it doesn't tell us the whole story. And so we talk about charting basics. One of the ways that some traders then took that line chart and then expanded it was to make it a daily expression. So I'm going to go to my style tool here, and I'm going to go to a bar chart. And this is what's sometimes referred to as Western style charting. Not Western as in yeehaw, but Western as in the Western hemisphere as opposed to Eastern style charting, which we're going to talk about in just a second. So you look at these bars, and these express some movement over the course of each day. I'm going to zoom in, and I'll show you what that means. We'll zoom in on one of these bars. So let's take this big red bar right here. The opening price for the day, where time starts, is on the left-hand side. That's going to be our opening price. And I'll just draw this in real quick. Opening price is going to be right there. Our closing price for that candle or that time period is going to be right there on the right-hand side. And the high for the day is going to be right here. And the low for the day is going to be right there. If that were a 1 week candle, it would be the high for the week, it'd be the low for the week, it'd be the opening price for the week and the closing price for the week. If it were a 1 minute candle, it would be the high for the 1 minute time frame, the low for the 1 minute time frame, the open for that 1 minute time frame, and the close for the 1 minute time frame. And you get the picture there, right? So now that we have that understanding, now we're going to take this from Western candlestick charting to the East. And we're going to go to the Japanese rice markets of the Middle Ages. So come with me now. We're going to go back to the rice markets of the Middle Ages, and we're going to employ what are called Japanese candlesticks, or just candlesticks if you want to call them that. We're going to go to our style tool. We're going to go down here to our chart type, and we're going to go to candles. And you can see I have the same information in these candles, just a bit more of it. So my opening price is still going to be down here. I'm sorry, excuse me. Let me delete that. My opening price is on this big red candle. My opening price is going to be up here. It's always going to be on the left. And my closing price is going to be down here. And my high is going to be there. And my low is going to be here. Now, by the way, Cameron May, who's out there in the chat, he does a lot of work in his Friday Advanced Charting Techniques webcast, where he talks about candlesticks and different ways to view candlesticks and different studies that can help to interpret candlesticks. So how do we know the time frame? Well, again, it's going to go back to your perspective and how long you want to be in the trade, and a candlestick can meet that time frame because we can change this chart. Once again, let me delete those and we'll come back over here. And I'll change my time frame once again, and we'll make this a 1 day, 1 minute candle. And so now we're seeing a lot of that noise here, but each one of those candles represents 1 minute of trading time. And you can see those candles moving as each successive minute passes by. And then we can also move that out to that 3-year weekly chart. And then each one of these candles represents 1 week of price movement. So that's a great tool that can be helpful to project and visualize that information. So now that we have that understanding in mind in terms of the chart, there's some other information on this chart that becomes helpful to viewing what's going on. So I'm going to put this back on our 1 year daily chart. Down across the bottom, I've got my time scale, but also across the bottom, I've got these pieces of information. I've got dividend announcements marked by that $sign. I've got earnings announcements 4 times a year, at least right now. 4 times a year, publicly traded companies are required to post their earnings. And the assumption is that there is accurate information in those earnings announcements. Barring any nefarious information or nefarious purposes, it's very likely that it's going to be pretty accurate because it's got to be audited and things like that. So, but we know that with statistics, we can tell stories, right? So the stories that the company tells with statistics are going to influence the price movement of the underlying stock on an ongoing basis, right? So, and that's Cameron May, and he's the one who's in the chat for you right now. I'll let him post a link to that particular webcast series that he teaches on Fridays in advanced charting techniques. He does come on every Friday. He's here quite often, as a matter of fact. All right. So taking a look at Google here, and we're starting to see this price movement. Right at the moment, we've got a little bit of a down candle, meaning price today is moving in a downward direction. We've got an earnings announcement coming up. But you know what? I know that there are some other stocks that are out here that are also moving around that might present us with an entry point that might be at the occurring at the moment. And again, the decision of when to get into the trade is going to be based on a lot of different factors. It could simply be based on just trend, the trend of the stock as it moves higher. So I'm going to take a look at a different stock here, and I'm just going to put in a different name here. I'm going to put in MU, similar space. This is Micron Technology. Many of you have probably heard about this particular stock. And what I happen to notice here on the right-hand side, I'm going to remove this line that I've drawn. But by the way, you can draw lines on the chart. And we can just draw simple lines and connect the dots. And it's kind of fun to do that because it gives you a sense of what the price of the stock is. And it helps us to visualize what the directional price movement of price is. I'm just going to draw that diagonal trend line here. And I can see that I've got maybe a horizontal trend line that's going sideways where the price of the stock has come down and found the same level a couple of different times, maybe starting to bounce a little bit here. So this is Micron Technology, and Micron Technology is bouncing up from a low. Now, there's a difference of opinion for maybe fundamental traders versus technical traders, and the difference of opinion really comes home to roost in a circumstance like this. Because a fundamental trader is going to look at all of that fundamental information and say, hey, the market doesn't recognize the value of this company. So I want to buy this stock at its absolute lowest price because eventually the market is going to recognize the value and it's going to lift the price of the stock. So a fundamentally driven trader is going to be looking for the absolute lowest price. The problem is we never know the absolute lowest price unless it's in our rear view mirror. So a technically driven trader is going to say, yeah, I want to get in at a price, but I want to be confident that the price of the stock is moving in the direction that I want it to go. And I want to have evidence that the price of the stock is moving not to a new low, but maybe towards a new high. So a fundamentally driven trader might get into a trade here, which is fine. There's nothing wrong with that. But we didn't know until it actually happened that the price of the stock was going to go up the next day and then the next day. The price of the stock could have done this and continued to go lower. You don't have to raise your hands, but just think to yourself, have you ever bought a stock and had the price of the stock go lower after you bought it? I have too, and very likely so is Cameron. But we want evidence. Now, it's not going to be guaranteed, and there are never guarantees when you're talking about technical analysis or fundamental analysis or anything else, but I want to have some confidence and evidence that the price of the stock is moving in the direction I want it to go. So I think to understand the question of what direction do I want it to go, we have to understand why it is that we buy stocks. By and large, we buy stocks to see the price of the stock go up, to have them grow in value. So right now, I've got evidence that the price of the stock is moving higher. So for me as a technical trader, what I might say in terms of my if this then that statement is if price is moving up, then enter the trade. So now I have that evidence that the price of the stock is moving in a higher direction, moving in an upward direction. Not a guarantee. Now, for an exit decision, if I were already in this trade and I had been holding on to this trade as the price of the stock was kind of churning around here sideways, I might have looked at this point in the stock price movement and said, you know what? It's gone back down to a low. It's gone back down to a low that the price of the stock has been at before. So if it goes lower, then I want out. I don't want to ride that bus all the way south if my goal is to go north on the bus. So I'm going to make a decision. I'm going to say if price breaks this level, then I'm going to exit the trade, else I'm going to wait. So if our level was somewhere right around 820 or so, we maybe said if price breaks 820, then I'm going to get out of the trade, else I'm going to wait. Now we're waiting and the price is going back up. So it keeps us out of that scenario where we ride a losing trade or a potentially losing trade into a much longer, deeper loss by giving in to those human cognitive biases that suggest that we give it one day more, and then we give it one more day, and we sit and wait and watch that gain that we had evaporate away and get shot down from the battlements and from the barricades. So now we're taking a look at this price. We're seeing that the price is bouncing and moving higher. We've got set that upward movement. This is a candlestick that is showing upward movement today. The open was right here. The current price is right here. It's not closed because the market's not closed. The current high for the day is up here, but because the day is not closed, it could be a higher high. And the low is right there. And because the market's not closed, that low could be at a different point. We've got a couple of hours left in the market. So given that, what we're going to do in this particular case is we're going to go ahead and enter an example trade because this price is moving a little bit higher. So I'm going to just simply right click on the chart here. Now, when we get later into this series, we're going to talk about managing risk. Because remember, one of the components of that process was not only determining what we're going to trade, when we're going to trade it, but how much we're going to trade, and then getting out of the trade, right? Determining where we're going to get out of the trade. So I'm just going to go ahead and I'm going to buy this stock right now in this as an example, not a recommendation. This is Micron Technologies. It's going higher. It's bouncing up off of, I'll just kind of describe this for you. It's moving higher. It's in an uptrend. It's holding a level of support, and it has bounced up off of a level of support. And it's given us something, I'll just tease this a little bit, that we call a hold, a close above the high or a trade above the high of the low day. I'm going to put this in my market movers group just so that I can come back to it and watch it on an ongoing basis. I'm just going to buy 100 shares of this stock. And there we are. We'll see if we get into this trade. We'll let it sit for a minute there. We'll be patient and see if we can get this order filled. Patience is a virtue here, Grasshopper. Waiting for this trade. Don't try to chase the trade. Working the order is one thing. Chasing a trade, even using technical analysis, is entirely another. So we're going to see if we can get into this trade here. We've got a limit order in place. Again, not a recommendation. We're just simply looking at getting into the trade at or near where it is currently trading. And we might move that up a little bit, give it a little bit more room, but I'm going to let it sit and work for just a minute here. Now we are running out of time, so I want to make sure that this order fills. So the cool thing is on the Thinkorswim platform, I can just grab that order on the chart and I can drag it up a little bit. And then I can go to that confirm and send box. I can read through the order, make sure that that's what I want it to do, make sure that it's going to the right place, and we know what that cost of the trade is going to be. And I'm going to go ahead and I'm going to click on send and replace that order. And now we got into the trade at 972.86, which is about where we wanted to get into the trade. And there's no guarantee that the price of the stock is going to go up from here. So we would at some point put a management type of position on here, meaning putting a stop order or some type of option order in place to manage that risk. But that is the basic understanding of technical analysis. And as we pop back over here and we look at some of the things that we've talked about in terms of chart basics, we talked through bar construction and bar chart basics and the understanding of candlesticks a little bit. And I gave you some resources to find more information about candlesticks. And we talked about those colors, and we talked about open and high and low and close. And so we've looked at those examples on a chart. So we've talked a little bit about the what and the why and some of the principles and charting basics and the key points of charts. And we've entered an example trade. So let me show you where else you can find additional information. I'm going to pop over here really quickly to the Trader Talks webcast page, youtube.com/at Trader Talks webcasts. Now, the Trader Talks webcast page is a virtual treasure trove of information about technical analysis and other things. But if you wanted to go to the Getting Started with Technical Analysis playlist, you just click on playlists here and you scroll down here to Technical Analysis Concepts playlist. Take a look at that full playlist and you're going to see, look at this. We've got lesson 1, Intro to Charting, lesson 2, Trends and Moving Averages, Support and Resistance, Candlestick Patterns, Flag Patterns, Patterns, who's got the patterns, and then technical indicators, and then divergences. So that's the rotation here in this technical analysis concepts playlist. But if you wanted to take a look at a particular individual concept like time frame, you can just type it into that search box and you can say, hey, chart studies, time frames, colors, look and feel. How do you build your system? Time frame, multi-time frame analysis with weekly and daily MACD, advanced charting techniques. Stock investing for beginners is a great way to do that. Setting up your desktop chart with time frames. That's a great way to get started with this. First Timer's Guide to Setting Up Charts. Again, Cameron May talking about that. A lot of different tools that you can use. Now, a couple of things that I want to do. I want to go back here to our coaching page, schwab.com/coaching. And this is where you're going to find our forward schedule of our webcasts that we teach on a regular basis. It's also where you're going to find our in-person events. So I'm going to encourage you, if you are anywhere out there in the area and you can travel, we teach this concept of technical analysis in a one-day format. And then we talk the next day about option strategies. The next time we're going to do that is in Orlando on August 8th and August 7th and August 8th. We're going to be down there in Orlando. This is at no cost to you. You can come and join us for that. Obviously, you've got to pay for your own travel, but the workshop is at no cost to you. And we're going to buy you breakfast and we're going to buy you lunch. And so it's a great opportunity to learn with a lot of other like-minded people. There will probably be 600 or maybe 700 other traders there at this workshop. So we'd love to have you there with us. We have a market drive, which is a one-day sampler platter of what we teach, coming up in Dallas on August 1st. And then we've got our advanced option strategies workshop for those of you that are trading options on August 20th and 29th in New York. And then we've got Washington, D.C. We're teaching technical analysis again. Great, great resources. All we ask is that you click on that subscribe button if you haven't done so already. Give us a like. You can also follow us on social media. I'm at Ben Watson CS on X. Cameron is at Cameron May CS. Leroy, thank you for telling me that. I appreciate that information. Thank you. That is why we do this. So we look forward to seeing you all out there in the workshops and in the webcasts and in our short videos and our social media. My thanks to Cameron May for helping out today. And guys, go out and make it a great day. The market's moving. This is a fun environment to get to know and to evaluate. And technical analysis is simply one way to help us to frame our decision-making process. So we'll see you guys again very soon. Take care, everybody. Bye-bye.